So you've done all of the hard work, you've performed your in-depth multi-timeframe analysis, you've built the higher timeframe story, you've refined your zone to the exact area that you want to build your trade idea around, you've ticked off every single piece of confluence that you need to see in your trade plan, and your entry model has set up, and you've now executed the trade. So you are now in a live position with your capital at risk, and your profit and loss on your trading account is floating up and down with price. Great. Now what? If you do not know exactly how and where you are going to exit your position before you have even executed that trade, then obviously you should not be in that trade whatsoever. You need to have an extremely clear and relatively mechanical way of managing your trades that you can repeat the same way every single time. Because for most traders, myself included, once you're actually in a trade, this is when emotions can really just be at their highest. Because you can see your profit and loss fluctuating up and down with price, and you've got risk there, your money on the line. Pretty scary stuff, right? I remember, that money to you is the risk of life to your inner caveman. So all of a sudden, your survival instincts are going to start kicking in, and you're suddenly going to have this enormous desire to just want to win. And this is when your amygdala is going to be trying to go into fight or flight mode, and it's going to force you to make all of those common trading errors in order to try and help you avoid those perceived pains and in order to try and protect you. But we know that that's not going to help us make money in the long term, right? So this is where we're going to need to really develop and test extremely clear and simple trade management rules so that we can almost blindly follow them. So what actually is trade management? Well, it refers to everything a trader actively does after a trade is executed to both minimize risk and maximize the potential profit. So it's the specific actions made by the trader whilst a live trade is open, so essentially when and how the trader exits their positions. Now, if you have watched the Trading in Edge module, specifically the lesson that is called Developing a Strategy with a Positive Expectancy, then you should be familiar with this diagram and the concept of profit expectancy. So essentially, just a quick recap, the amount that you can expect to make on a trade on average over the long term, that is a factor of both your strike rate and your average P&L. So the lower your strike rate is, then the higher your average P&L needs to be for you to be profitable. And obviously vice versa, the higher your strike rate, then the lower you can get away with your average P&L being in order to be profitable. Now, trade management will obviously have a major impact on both of these factors and therefore your overall profit expectancy. So once you are in a position, attempting to minimize your risk exposure and maximize your potential reward, that will be decided by how you manage that trade once you are in it. So mastering trade management is going to give you a high chance of achieving long-term consistency in your trading results by managing your positions pretty much the exact same way every single time. Because then you are bringing a consistent approach to what is a random market. And it will also help you to achieve high returns by maximizing the potential reward, by not cutting your winners too early and knowing how to minimize your risk as quickly as possible in an effective way that doesn't actually choke the trade too early, so that you can actually let the trade play out in your favor. And as a direct result of that, that will lead to your winners being far bigger than your losers. So then you are tilting the numbers in your favor. And that is how you develop a trading edge and how you improve your profit expectancy via trade management. And then finally, developing a management strategy that you actually resonate with, so that it is congruent with your own unique trading personality and it's then easy on your own psychology. That is really going to massively improve your performance over the long run, because it's going to increase your actual adherence to your trade plan, so that you actually stick to your rules and you're not deviating from your plan and just end up taking just shitty trades that just are not a part of your proven trading edge. So we know the benefits to nailing down an effective and repeatable trade management strategy, but what does that actually entail? What tools can we use to build such a management strategy? Well, there are three main tools at our disposal, and the first of those is using take profit orders. So a take profit order is very simply a type of order that specifies the exact price at which to close out an open position for a profit. So if the price does not reach the order price, then the take profit order does not get filled and the position will remain open until the take profit is hit or the position then hits your stop loss. The second method is using partials. So this is essentially pretty much the same as using a take profit order. Except instead of just placing kind of one take profit order, which completely closes you out of the trade with your full volume, instead you can set multiple take profits along the way to slowly partial you out of your position with different amounts of trade volume. So for example, you could set a partial take profit quite near your entry so that when price hits it, you will close 20% of your trade volume for a profit. And then you can set your second take profit further away from your entry that will say, close out 70% of the trade volume for a profit, and then a final TP to close out the remaining 10% of your trade volume. So that's the second method. And then the final method is to use a trailing stop loss. So for example, if you're in a trade, once it starts to move into profit, you can then trail your stop loss order into profit 2 behind price in order to remove your initial risk. So this is a really common way for traders to move their trades to break even as they move their stop loss around their entry price. But then as the trade runs further into profit, you can start to lock in some of that profit by trailing your stop loss even further along with the trade, before finally price will eventually retrace to wherever your trail stop loss is, and it will eventually stop you out of your full position for a profit. Now, there are some pros and cons to each of these methods. With the first method, so just setting one full take profit order, this has the benefit of a very hands-off, that kind of set and forget approach. Because once you are in a trade, you can basically just set your stop loss and your take profit order and essentially just walk away. So in that case, you are either stopped out for a loss or you will hit your full target for your full profit. It's very simple and pretty mechanical in that manner. What it also means is that when price does reach and hit your TP order, you are then closed out of a position with the full volume size of the trade. So this is in comparison to, say, partialing in the second method, because with this first method, when price does hit your final TP, you will not make, with partialing, I should say, you won't make as much money when price actually reaches your final take profit order, because you have taken volume off your position along the way as price is getting there. But when you're just using one full take profit, like in the first method, if price hits that, then obviously you still have your full volume on the trade at that point. So you're kind of maximizing your profit in that manner. Now, kind of a downside and a negative to using just one full TP is that you can end up giving a lot of running profit back to the market, because price could come within, just even one micro pip of your TP, and then it could reverse and pull all the way back down and stop you out for a break even or potentially even a full loss. Another drawback of this method is that you do not cover your initial risk unless you combine this with the trailing stop loss method and trail your stop loss to break even at some point during the trade. Now, in the second method with using partials, this can also be a very hands-off approach where you can obviously just set your various TP levels with the set volume to be partialed out as soon as you enter the trade. So, once you're in it, you can just go you set those 3 or 4 or however many TPs you want along the way, and you can predetermine how much volume is taken off. And this also gives you the benefit of kind of paying yourself along the way, so that if price does not reach your final target, at least you will have banked some profit along the way, right? Now, one of the other major benefits to partialing is that you can use it to cover your initial risk without needing to trail your stop loss to your entry price. Now, we're going to talk about this in a bit more depth in just a few minutes. But essentially, let's say your trade is running at 4-hour profit. You can then partial out 20% of your position. So you close 20% of your trade volume at 4-hour profit. And this will cover your initial risk. So that if price then reversed and stopped you out, if it hit your stop loss, you will actually be net break even overall. Now, the main benefit of kind of removing your risk this way compared to just trailing your stop loss to break even and not taking any volume off is that sometimes price will pull back to your entry level before then continuing again in your favor. But if you had trailed your stop loss to break even, then you would have been stopped out of a position that then went on to be a big winner, right? So it's kind of, instead of you kind of just partial out some of your volume to cover your initial risk, then this means that you don't need to trail your stop loss. And it just allows you to give the trade the room that it needs to play out in your favor, because a lot of the time price will pull back a little bit to kind of around the level that you entered before it then continues. So you just need to give it that room to play out sometimes. Now, an obvious drawback to using partials is that obviously when you do hit a big winner and price does reach your kind of final target or your further out targets, then you will not have as much volume left on the trade because you've been partialing along the way. So you won't make as much money as just using one full take profit like the first method. So that then brings us to the final method of trailing stop losses. And one main benefit is that you can move your stop loss to break even, so you are covering your initial risk, but you're still leaving your full trade size volume on the trade. So this way, if price does continue in your favor and it doesn't come back to where you trailed your stop loss at your entry, right? Then you will make more money compared to if you had partialed out some volume along the way, right? When price eventually does reach your final TP. Now, the other benefit to this management style is that you are essentially looking to trail your stop loss behind key structural points or behind supply and demand zones in the market as they form. So that if price then breaks those and it breaks down through them and it hits your trailed stop loss to take you out, then in theory, you should be exiting at the point of expectational order flow failing. So in more simple terms, you're essentially looking to exit at the first sign of a trend change, right? So if we were bullish and you were trailing behind the higher lows, if price then breaks that higher low, right, it breaks the downside to stop you out, then essentially that should be a bearish trend change. So in theory, you kind of ridden or rode, whatever the word is, to rode that trend as long as possible, and then you should be exiting as that trend is coming to an end, right? So in theory, that should be a very effective way of kind of riding trends until the end and maximizing your reward as much as possible. However, in reality, what you'll find is this method can very often lead you to being prematurely stopped out, because what can happen, as we know after the liquidity module, right, price can just wick those structural points or zones as a liquidity grab before then continuing the move in line with the overall predominant trend. So trailing stop losses can be quite hard to use in reality. Now, the other drawback is that it requires a much more hands-on approach with pretty active management in order to be watching price and trailing your stop loss behind structure or zones as they form. Because remember, FX is obviously a 24-hour market, right? So price will be moving around the clock. So you do want to bear that in mind if you do choose to manage this way. So all of those pros and cons across those three individual management methods, they are not an exhaustive list by any means whatsoever, but they kind of are the main ones that come to mind kind of thinking about those three methods there. Now, my personal and kind of quite general advice to you would be to focus on using either the first method, so a full TP, or the second method with using partials. I would kind of only really consider using a stop loss trail just for moving to break even and not really anything else. I wouldn't really advise trailing your stop loss to lock in profit, as I don't personally find it to be the most effective management method compared to taking partials along the way. But as always, that's just my own personal experience. Please use what works for you and just keep testing and refining throughout your trading career. So now we understand the management tools that are available to us. How do we actually decide and know where to set take profit orders or to set those orders to partial out along the way on a specific trade? Well, there are two main ways that we can do this. The first is based on fixed R, so the fixed R method. Now, this has nothing to do with price action or sort of any technical factors. This is just purely based on sort of the math side of things. So in other words, you will always set your take profit order at a predetermined amount of profit. So for example, you might always exit your full position at 5R, or you may always partial a set amount of volume at a set amount of running profit. So for example, you might always partial out 20% of your position at 4R profit, and then the remaining 80% of your position at 10R profit, right? Now that's fixed R, but the second method of setting TPs or partial orders is based on technical targets. So this is where you are looking at price action to decide where to place your orders. And you're essentially asking yourself, where is price going to potentially pull back or maybe even reverse? And it's those areas in which you want to be taking profit. So these will either be at unmitigated supply and demand zones, so those fresh zones, right? Or structural points in the market. Because obviously if price hits a fresh zone, we would expect some form of a reaction. And likewise, when price breaks a structural point, whether that's a swing high or a swing low, or a set of equal highs or lows or whatever, what do we expect when price breaks that? We expect a pullback or a reversal as price fills and sweeps that liquidity, right? Therefore, these become really great technical areas for us to look at, to kind of aim for our trade to run to, and then to look to take profit or even just partial profits there. Now, of course, you can use a combination of both fixed R and technical targets. And a very basic example could be something like this. So let's say you are taking a trade that is with the M15 trend, right? So pro the M15 trend. And let's say that you enter on the M1 time frame. And then when price is running at 4-hour profit, you will then partial out and close 20% of the trade volume. And what this means is that you have actually covered your initial risk so that you do not need to trail your stop loss, because if price does stop you out, you will actually be at net break even. So what you have done is you've used a fixed R method to cover your initial risk, but then you can use a technical target to manage the remaining volume of the position. So for instance, placing a take profit for the remaining 80% of the trade volume at the nearest weak M15 swing high or low. So hopefully now your brain is starting to tick over and kind of start to think about all of the different ways in which you can devise a management strategy that makes most sense to you, that works in line with your overall strategy, and something you can actually execute with your current lifestyle. But as always, try to keep it as simple as possible. There is no need to make it overly complicated, sort of whatsoever. So we've spoken about this a fair bit already, and that's using partials to remove your initial trade risk and essentially break even a position you're in, because partials allow you to remove risk without choking the trade. Like how can happen, if you simply just trail your stop loss to your entry price, obviously price could just come back a little bit, tag you out for break even, and then continue in your favor. So let's look at kind of the numbers behind this. So let's say you close 20% of your trade volume when you are running at 4-hour profit to cover your risk. If your account is, let's say, £100,000 and you risk 1%, that's going to be a £1,000 risk on that trade. Now, if you're running at 4-hour profit, at this point you still have full volume on the trade, so 4 times your initial risk is £4,000 floating profit, right? But this is where you can then partial out 20% of your trade size. So you would essentially close out 20% of your profit, and that means you would bank £800 profit, 20% of £4,000, right? Now, because you only have 80% of your initial volume running left on the position now, after you've partialed out, this means that if the trade were to then reverse against you and actually hit your initial stop loss, instead of being stopped out for that full £1,000 of your initial risk, you are now only stopped out for a £800 loss. So obviously that initial £800 profit that you banked when you closed out 20% of the volume at 4R, that is then cancelled out by the £800 loss that you take when your full stop loss is then hit, which then will net out to give you a break-even trade overall. Now, one thing that you will need to kind of pay attention to and consider, more specifically, if you are someone who trades with very small stops, your lot size will be quite high, so generally your commissions will be pretty high too. Now this, of course, it's going to vary broker to broker, but if your commissions are quite high, then you may want to partial out a little bit more volume, just so that you make sure that you are still net break even overall, because if you do take quite a lot of break evens with your strategy, then those commissions really can start to add up and eat into your P&L kind of over the long run. So back once again to the infamous sort of utopian trade example, annotating the strategy that we've been looking at throughout all of the lessons so far. I'm not going to obviously break down all of this price action again in order to depict how we actually arrived at this point for looking to take the trade. Obviously this is just going to be purely focused on kind of just giving you a rough example of how you can begin to think about how you may want to manage positions, potentially using a combination of both sort of the fixed R method and also using technical targets. Because I think if I haven't kind of made it clear already, the reason why I would personally, or at least I personally prefer using a combination of both fixed R and technical targets, is because what fixed R allows me to do is it allows me to remove my risk in a very mechanical way the same time every time I enter a trade. So i.e., let's say over here I enter this trade here, I'm tagged into the position. Now, I could start looking for technical targets to start to look to potentially take my full take profit or to take partials. But actually what I want to do is I just want to know how I'm going to, initially remove that initial risk that I took to enter that position. So, essentially protect my stop loss. So there's obviously one or two ways you can do this. Either you trail your stop loss up to break even, or you can take a bit of volume off your trade once it's running in profit to then cover your stop loss so that if price then goes in your favor, right? Say you're running about 4R up about here, you then bag 20%, right? 20% of your volume you then bank. So that then if price comes back down and then stops you out of your remaining 80% of your volume, that is actually a net break-even trade. So the way I personally like to use fixed R for that initial kind of first step of my management, just to remove risk from my trade. Then after I've done that, so it's always based on a fixed amount of profit that I'm running. So as soon as I reach 4R, it doesn't matter where that is. That could be down here before the lower time frame high that you've entered on. So let's say this was the M1 time frame, right? Sometimes this is going to be a big swing, sometimes it's going to be a tight swing, and that's why it's going to differ every trade where 4R will be. Sometimes 4R will be here, sometimes in this case it would be here, sometimes it might be a lot higher up, right? But that's why, for me, removing my risk generally most of the time is not done on that kind of first technical level, but literally just where am I running? Because what I found is kind of two main benefits to that. One is the psychology side of things. You don't have to think about it too much. It's just, as soon as it hits 4R, boom, I know what I'm doing. Just really helps with emotions. And two, secondly, the technical side of things, because it differs from each trade. It's just easier to do that. But actually, the point I was trying to make, which is even more important, is that you're just playing, everything we learned in the trading and edge module, right? Of trying to stack that average P&L, that average reward to risk ratio, combined with your strike rate in your favor. If you kind of just try and be the casino rather than the gambler, where you kind of try and fix your odds as much as possible, I think utilizing the fixed R method is one of the best ways for doing that, because if you always that all of your winning trades are going to exit at 4R or 10R and X amount of volume at each of those levels, then you can start to really use all of the data that you've collected through your testing and your live journaling to kind of figure out what that best combination is for you. So this will take time to figure that out, but it will just come with testing and more live trading in the market. So just to keep things really simple, let's say for example that no matter whenever you're in a trade, you wait until 4R to take some volume off your trade. So let's say we get about here, you can then take off that 20% of your volume. That means if you're stopped out, you are at net break even, but you get to leave your stop here rather than trading it up. Because what can happen obviously is price can come up, it can break that lower time frame high, you then take off your volume, and then after it sweeps that high, right, price could obviously pull all the way back to here, tap into that freshly created demand zone, right? This is kind of something, if you find yourself being emotional where you see your trade running in profit and then you see it pulling back towards your entry, and sometimes you can get a bit emotional about it, right? And you can kind of have to fight that urge to not either, exit the trade at break even or, chose stop loss up, and just look and reanalyze price. Like you always want to delete the risk to reward tool off your charts and just look at price action and analyze it as if you were not in the trade. And that can really help you to remain neutral. Obviously, don't forget that you're in the trade, but just kind of look at it as if you weren't in the trade. And then what you'll actually notice, instead of sitting there in fear and going, oh God, price is coming back, my profit's going, I don't want to take a loss, actually, you can analyze price and go, well, what's happened? We've broken structure. We've created a new demand zone. What do we know after price break structure? We know it pulls back, and it's probably most likely just coming back to fill those new orders of near where I entered. So, no need to panic. Let the numbers fall where they're going to fall. Let price play out. Let's do whatever it's going to do. We have no idea what it's going to do. You've done all the hard work. You've stacked, the odds in your favor. You've executed your edge. Don't now balls it up. Let your emotions get the better of you. Just delete the risk to reward tool off your charts. Reanalyze price, see actually it's probably just coming back to this demand zone, and then ideally it will continue, and of course there will be times where it just smashes straight through, but yeah, who cares? And especially when you've kind of used the partialing break even method to your advantage, that can give you a little bit more breathing room, because sometimes it will come a little bit lower and then continue. Okay, so yeah, very simply, let's just say 4R, we take off 20%, and then we can start to think about technical targets now, right? Kind of the second component. And the reason why this is beneficial is because once you've removed your risk, now you can use your technical analysis to your advantage, because rather than saying, okay, I've taken 20% off at 4R, now my second management step is going to be, let's say I'm going to take 80% off at 10R every time. That can work, and I would recommend that for some people, but every single trade is going to be different, because sometimes 10R could be here, sometimes 10R could be here, right? It's all going to depend on price action, how big the range that you are within, whether it's your higher time frame and your medium time frame. There's every trade is unique, right? And it's always going to set up slightly differently. So I think that's where technical targets then are a lot more beneficial, because then you can go, well, actually, now I've removed my risk, I'm pro the M15 trend, the medium time frame, I'm pro my higher time frame, let's say the 4 hour as well. Everything's aligned. Actually, I want to try and push this trade quite far. So then you can go, okay, well, the next kind of major barrier is going to be that M15 week high. And it's a week high, right? Because it didn't take out the swing low. So this is going to be the next good technical target, because what do we expect after price is going to break that? It's either going to pull back or potentially reverse, right? So this can be a next decent level to take, I don't know, let's say 60% of your volume off, right? A decent amount of volume off there. And then you've got, I think, that would be 20% of your volume left. And you can go, okay, well, I'm pro trend. I'm going to try and swing that remaining 20% for that 17R up to the week 4 hour high. Okay. And that's kind of then how you can bring in those technical targets to kind of help you maximize your profit potential. But it's then tailored to each individual setup, if that makes sense. So rather than just going, I'm always going to take, partials at 10R and then the next remaining partials at 15R, that's good because it's based on the numbers. But you could be cutting yourself short a lot of the time, or 10R could be up here and then you're trying to push price too far, and then after it breaks structure, it's going to pull back, and then you could end up, not banking anything when you were running quite a lot of profit. So that's why I personally prefer kind of fixed R for initially removing my risk, and then I prefer technical targets for kind of the bulk of the remaining volume that I have left on the trade, just because that makes a lot more sense. Now, obviously, discretion is going to come in a little bit when you're using technical targets. But that's where I try and make that mechanical as possible. And I would say, I'm always then going to take off X amount at the M15 high and then X amount off at the 4 hour high. Now, of course, whenever I say specific timeframes, right, remember it's whatever that means to you. So, in my case, the higher time frame would be the 4 hour, the medium time frame would be the M15, and the lower time frame would be the M1 or the 15 second, for example. But of course, that could be, your weekly, your daily, your 4 hour, yada, yada, yada. So yeah, that kind of wraps it up, right? Hopefully that makes a little bit more sense. You don't have to follow that kind of exact method, but it's just to kind of get your brain thinking, just understanding how the fixed R can be beneficial and also how technical targets can be. You can just use one or the other. You don't have to use a combination of the both, right? Let's say you just wanted to use technical targets. Well, then what you could do is you could go, I'm going to go to break even once I, break that first nearest week high on my execution time frame. So in other words, if I enter on the M1, as soon as price breaks this M1 high, I'm just going to trail my stop loss to break even. Now, I personally wouldn't recommend that, but that can work out. And obviously, what's the one beneficial or the one benefit, the one pro to doing that compared to partialing out to break even, is that when you want to, if you have a really high probability swing trade and you have high confidence that price is going to, have a pretty decent run, well, instead of taking off 20% of your volume really early, you might actually want to hold onto the trade for a lot longer so that you can have, a much bigger amount of volume when price does reach here, so that you obviously can, make higher returns if price does go in your favor. And that's where, just trailing a stop loss to break even can be a bit more beneficial. So you could either do that, when price breaks your execution time frame high, or maybe you want to leave your risk open and actually just not move your stop to break even until, say, your medium time frame high is broken. So that means you would enter the trade and you would do nothing until this high is taken, and then once that high is taken, then you're happy to trail to break even there. Okay, so just kind of experiment a little bit, but yeah, the kind of the nearest way to the way that I personally trade at the time of this recording is that I like to have a fixed R method for initially removing my risk, and then I like to look at technical targets, which will generally be the next sort of M15 swing high or low, right? Whatever way I'm trading. Obviously, if it's bullish, I want to target that week high, and then sort of try and swing that remaining bit of volume up to that 4 hour high there. Now, another way you can kind of think about it, if you want to be a bit more of kind of that kind of more pure day trading approach, and you like to be completely flat by the end of the session, the London or New York session, or just by the end of the day, so you have no positions left running, is you could just, always just play the M15 range. So you could literally take off all of your remaining volume by the time it gets to that M15 swing high, swing low. And then obviously when price breaks that high, then potentially the next day we could then be playing, within this next M15 range here, and then you're playing that next range for the day. So then you can look for an entry in here to get long, and then you take off all your volume off here, right? And then you just play the next M15 range, and you keep playing that until we get up to the 4 hour swing high. Then when we get up to the 4 hour swing high and we get that 4 hour pullback the next day, which obviously would be how this would look here, then you can start playing those counter trend M15 ranges, right? And you're just getting in and out, playing those M15 ranges, being flat by the end of the day. But of course, others of you may prefer to be a bit more of a hybrid approach, which is a bit kind of more similar to the way that I trade at the moment, which is where I would take a healthy amount of volume, a decent amount of volume off kind of near these M15 ranges, but then try and swing, obviously if it's pro trend, try and swing some volume up towards that nearer swing high and try and push the trade as far as possible. Only other last thing I do want to mention before I forget is counter trend trading. Now, it may be a bit simple, or some of you may just want to have one management method and just stick to that same way every time, but I think it makes a lot more sense if you are someone who is going to trade counter trend to kind of have a slightly different approach for when you are trading counter trend, because you are going to need to be a bit more aggressive. So let's say you got short here, right? So this would be counter the higher time frame trend, but pro your medium time frame. So let's say this is, pro the M15, but counter the 4H. Obviously in this case, there's a long way to go all the way back down towards kind of, this origin demand zone, and it's quite a big range. So you may want to swing this a little bit further. But what I would recommend is kind of taking a healthy amount of volume off at the next nearest low. So in this case, you may want to take off like 80 or 90% of your volume at the nearest sort of medium time frame low and be really aggressive, and then maybe push a little bit longer. Or if you're entering much nearer kind of the 4-hour discount and price could turn around and switch bullish at any point, then you may just want to literally just target a fixed 4-hour, fixed 5-hour, be in and out and just full TP, right? Full trade volume, and not even bother trying to push it even further. Okay, but yeah, I would definitely recommend kind of having kind of your pro trend conservative approach, management approach, and then kind of your aggressive counter trend approach, and try and devise some sort of creative ways, but keep it simple, don't overcomplicate it too much. And just kind of just experiment and see what works for you. So hopefully that's kind of all starting to make sense. Obviously, we will look at a lot more trade examples as we go on, and as you're kind of, absorbing the weekly content that we're putting out. But kind of just to wrap up with a few key points on this specific management lesson, there is definitely no one rule fits all when it comes to trade management. What will work will be different for everyone. So that's why you need to spend the time to find what suits your strategy, what suits your psychology, and what suits your trading personality, and of course your current lifestyle. So if you are someone who has an active job, then it's probably not likely that you can have a very active and hands-on management approach. So you may need to devise something that is a bit more set and forget, for example. And as I said before, try to keep your management strategy as simple and mechanical as possible. So this will give you a repeatable process in the market and something that is easy to test and collect data on, so that you can prove it works. Now, the more that you scale your account size, generally the harder it's going to be on your emotions, right? As you're trading more money. So you need trade management to be very simple and mechanical, almost so that a robot can execute it for you. Now, when you are using technical targets for your trade, there may be some discretion and differences between each trade when you do this. So what I would advise is that you at least try to be very mechanical in how you choose to remove the risk on your trade. So either always partial at a fixed R, or always partial at a set technical level, such as the nearest swing point on your execution time frame, or of course you can always try your stop loss to break even once price hits a certain level, for example. But whatever method you choose to use, just do it the same way every time, and that will help you to achieve consistency and reduce the chance of psychological errors. And finally, test, and test some more. You will always constantly be refining, tweaking, and evolving your trade plan as you grow as a trader. So just make sure that you are constantly reviewing the data that you are collecting, and very simply, just do more of what is working and less of what isn't. And you will find a strategy that is most effective for you personally as you continue to do this. And I'll just leave you kind of with one final little tip, and that is that I would essentially recommend that you leave a very tiny amount of trade volume on each trade that you take. Even if it's literally just 0.01 lots, just so that you can get experience practicing and managing a trade long term. And you might just surprise yourself at how far some of your trades will actually run. And obviously this is quite hard to do in reality, from a psychological perspective, in terms of holding a trade with your full volume on for a long time, because you can be running at a lot of profit. Price is obviously going to have to pull back, right? You're going to have those higher time frame pullbacks, and that can be very hard if you've got your full volume on. But if you leave kind of just an insignificant amount of volume on, when you're practicing, that you don't really care about, then at least you're still gaining that experience and practicing holding trades for much longer. And then of course you can slowly start to build from there.